So if you're the BOC wondering if now's the time to cut rates, calling it the mortgage renewal cliff, you've got this train coming down the tracks where if rates stay where they are now, and we're already seeing slowing in the economy, it means the payment shock almost doubles. What does that look like?
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Mr. Dave Larock, thank you so much for joining me today, man. I appreciate the time, the energy, and the opportunity, especially from a fellow mortgage professional in the industry, to join me on the podcast to talk a little bit about money, what's going on, and how great your golf game is right now. No comment. Thanks very much for joining me. Appreciate it. So we were having a good discussion, I think, before our conversation here about a lot of fun stuff. And, you know, what a better way to have a podcast than for two guys to just start talking and communicating and talking about what's going on right now. And the most recent thing that we were just talking about right now was obviously what's on everyone's mind. And not to date the podcast, but let's be honest, everybody is thinking about it and everybody's talking about it. And that's pretty much every decision that the Bank of Canada does throughout the year of 2024. Not to date us too much, but we're in the summer of 24, and you know, it's been an interesting year, but probably not shocking and surprising. You were just telling me about your thoughts and feelings on the most recent rate decision. Care to share a little bit more about that and what your thoughts were based on the most recent rate drop?
Sure. Well, just to quickly review, the Bank of Canada hiked its policy rate all the way up to 5% because inflation was too high. And that is an extraordinarily tight monetary policy level for record high levels of household and government debt outstanding. So they basically were doing that for as long as they had to. The justification was that the economic pain of higher rates was preferred to the economic pain of sustained inflation or sustained too high inflation. And we have now seen a lot of the economic data turn. The economy is slowing. We've got some weakness showing up now in the jobs market. Consumer spending is down. Inflation expectations have started to cool significantly. Businesses aren't spending on business investment. They're less confident. Price hikes now are less common. There's all kinds of indicators. And of course, most importantly, inflation is falling and continues to cool. In fact, the only inflation we've got left is really in shelter costs, and most significantly within shelter costs, mortgage interest costs. They're up about 22% year over year. And surprise, surprise, if the Bank of Canada starts cutting its policy rate, variable rates will fall immediately, and there's a good chance bond yields will follow. In other words, the Bank of Canada can solve the concerns over remaining inflation by going ahead and cutting, because the mortgage interest costs are directly tied to its monetary policy movements and its outlook. So the question after the Bank of Canada's first cut was, how many more are we going to get and how long is it going to take? When I looked back and did some research over the last 5 rate cut cycles by the BOC, it's taken an average of 15 months, and they've cut by an average of 2.35%. So if we're starting at 5, we should land somewhere around 2.5. That's also consistent with the Bank of Canada's research. They estimate that their neutral rate, which is the policy rate level that is neither stimulating the economy nor restricting it, is around 2.5 to 3%. So we're now down to 4.5. And the question is, how low are we going to go? Most of the major bank economists agree with the Bank of Canada's neutral rate estimate range, and they think that we should be landing around 2.75%. The timing of how long that'll take, well, that'll depend on the economic data and a lot of factors still to unfold. But if the average rate cut cycle takes about 15 months, and we're now 3 months in, then it's realistic to think that most of those cuts should be in place by the end of next year. That's important because variable rates are still higher than fixed rates. The question is, should you pay the upfront premium and take the bet that they'll be lower and that your average cost will be lower? I have said in several blog posts, I think the odds favor variable rates. Again, don't want to project certainty where I don't have it. I always say my opinion in $2 will only ever get you a hot cup of coffee, but I researched this stuff carefully, and I think I can fairly claim to have an educated opinion. And hand on heart, I think variable rates will save money, and I subscribe to the general view they have to keep falling, and that they're going to fall a lot from here.
Well, like there's a lot to take away there. Holy cow! So let's break this all apart in pieces here. The first and most important point about your conversation, we're going to wind it all the way back to the actual the fact that what's happening with the Bank of Canada is almost like a self-fulfilling prophecy in the sense that they've increased the overnight rate and interest rates follow that, which means that obviously inflation goes up and everything goes up along with it. They decrease rates and the same thing starts to occur. I mean, the stats most recently suggested that headline inflation would be under the target of 1.9% if we didn't factor in the mortgage interest costs, which is basically, as we mentioned, like a self-fulfilling prophecy. So your comment about rates going down significantly, I think is echoed pretty heavily now, which is funny because it wasn't 6 months ago, but it's echoed pretty heavily now across the economic world by many of the major economists suggesting the same thing, that, hey, well, we're already way under. If you strip out those mortgage interest costs, but then the theory or the thought process is, well, we can't just strip it out, like it is part of the picture. What are your thoughts on that? Like, do you think there's some weight to the conversation of either A, stripping it or looking at it as a separate metric, and or is there too much influence from mortgage interest costs, which are self-created?
Well, I think it's important to know where the inflation is coming from for sure. And interestingly, Ben Rabideau, who's a super smart economist, and a lot of us subscribe to his website, Edge Analytics, he actually said it's not 1.9 anymore. It was actually 1.9 in June. It's inflation, our CPI would be 1.6% in June if we stripped out mortgage interest costs. And yeah, I mean, I definitely think it's important to know where the inflation is coming from, and the fact that the Bank of Canada can directly control the remaining inflation pressure that there is. I mean, if you're saying should we cut rates? Oh, and by the way, when we do cut rates, we're going to cool inflation directly, and even more so than yeah. I mean, that's another reason to go ahead and cut rates. The other thing that's interesting is that in most of the other central banks in the developed world don't track mortgage interest costs because they are directly influenced by Bank Canada, or sorry, by central bank changes in monetary policy. They don't consider that useful information because they want to track the stuff they can't directly control. Another point to make, Alex, is the other costs that are driving inflation right now are shelter costs tied to record levels of immigration. And the Bank of Canada can do whatever it wants with its policy rate. They aren't going to solve the housing supply problem by keeping rates high. It's going to discourage investment in real estate. And the real challenge we have, and I love immigration. I think we need immigration. Certainly, Canada has an aging population, and immigration is going to be very important to be able to afford an aging population. But we can't. We have to. Our immigration minister and our housing minister should go for a coffee once in a while and get on the same page. And right now, we've let too many people in, and we don't have enough houses to put them in. But when you're the Bank of Canada and you're saying what kind of inflation can we cool with our policy rates, the answers vary. And in this case, number one, we've got too much inflation from mortgage interest costs, and that will cool directly when they cut. And number two, the other inflation pressure we have today is coming from shelter costs tied to record levels of immigration and a real imbalance between supply and demand in our housing sector. And those things are hurt by higher rates and helped by lower rates. So I think if you're the Bank of Canada, it definitely matters where the inflation is coming from. And if cuts mean they can help those inflation pressures ease, then that's all the more reason to do it.
Okay, well, let's touch on that briefly then. There's a few points that you made there. One, obviously, the immigration factor. Two, being the investment piece, the investment in our market and in Canada building, for that matter. So we've seen for a few consecutive months now that the amounts of construction or the construction starts have gone down, at least in many areas across the country. We've also noted that obviously we had record immigration for 3 straight years. So I mean that everybody knows that at this point right now. But we've also heard from our federal government. Whether or not it's going to happen is yet to be seen. But we've also heard from them that they're going to reduce the amount of immigration coming in substantially over the next 1 to 2 years. Now, one of the things that we do know is that, like, typically when people move to our country, they don't buy a house right away, contrary to these stupid foreign buyer rules and so forth. It's usually someone that comes here, goes to school, or gets a job. They rent for 2, 3, 4, 5 years, and then eventually they buy a home. Not your average person isn't just coming and buying a house in the first 2 years, at least not from what I've seen, for the most part, and not what we've seen in the statistics. So we've got 3 kind of like things working, back and forth against each other. On one hand, we have this weird, crazy oversupply of a certain type of units, and it appears to be mostly the Toronto region. Like, I've seen it some places in other areas of the country, so we've got a lot of supply there.
Vancouver
On
as
the
well.
other hand, yeah, we're seeing some of it here, not nearly as much as what I'm seeing reported out there, and definitely in some other cities outside of that. So we've got these whole whack load of condos, yet we're being told we have a lack of supply. but we do have people who need to be moving into homes, and we have less potential supply for later down the road. So there's all these conflicting points coming at us, and I don't know where they kind of diverge, because you've got, condo owners who are not going to sell them off for nothing, right? They're not going to just lose all their money, most of these people, right? You still have these record high rents, and you still have this immigration, you still have people coming, yet there's less people coming into the country. So do we hit some kind of equilibrium there at some point, do you think? Or I don't know. It's just like so much information data to make that decision.
Sure. Well, I mean, let's unpack some of the points you alluded to. Number one, when people come to Canada, even if they don't buy a house right away, they need a roof over their head right away, especially if they're arriving during the 6 months of the year where it's very cold outside. And the more demand you add to the rental market, it's an organic system. So even pressure at the lower end of the market or in the rental market, if you apply a ton of pressure there, it is going to percolate up. So it does add to the overall system pressure. As far as all the condos being built in Toronto, unfortunately, they're not really suitable for most folks. So most of the condos being built in Toronto now are 500-600 square foot condos. That they only appeal to a very small percentage of the market, and a lot of the condos that are coming to completion now were owned by investors. And those investors can't get their negative cap rates. They can't get rents to cover the costs by the time you add up the mortgage interest costs and the condo fees. And they've got to close on a condo that isn't worth what they paid for it and come up with huge down payments, unless, as is often the case, appraisals magically come in at exactly the purchase price, even though the market has slowed and there's really no justification for those appraisals coming in. But I think there's a bit of a quiet nod between the regulators and the largest lenders, the banks, who are financing the commercial loans to build those condos and the mortgages to buy them at the individual level, because they would create a massive price correction if they allowed the appraisals to reflect current market values. By the way, if I was a first-time buyer saving up my money waiting for prices to fall, that would really piss me off. The market should reset. Prices should go lower in condos. We shouldn't be protecting these commercial loans. And yes, there would be an economic shock associated with that, but that's how you clear out the deadwood in the system. I use this example all the time, as do others. You can prevent forest fires for a while, but eventually the deadwood in the system builds up that you have a massive fire that you can't control. Fires are a part of keeping a forest healthy, and price corrections in real estate are a part of keeping real estate prices healthy and allowing the market to reset. And if you do things like have a wink, wink, nudge, nudge between regulators and the banks, and allow properties to appraise at purchase prices when they should be lower because of values, and that allows people to close on purchases when they should lose their ass, then what will happen is prices will remain elevated for a while longer, but then you'll get a bigger correction. So I don't think it's the right thing to do. If I was playing by the rules as a first-time buyer and I didn't have a bank of mom and dad to help me out because prices had become unaffordable, I'd be waiting for the market to correct. And when things like this are allowed to happen, that natural process is delayed, and it creates a bigger economic, more damaging shock later. And it means that people who are playing by the rules are getting gamed by the powers that be. I don't want to sound like a conspiracy theorist, but I think all of that's pretty obvious right now.
Well, and I'm not saying that you're wrong in any way, shape, or form. I think that's obviously subjective to different areas across the country, as we talked about, right? And different communities and cities. But to that point, conspiracy theorist, I like that. To that point, you're
And
not
by the way,
wrong.
sorry to interrupt, Alex. I'm talking
Yeah.
about Toronto here. I'm talking about
Yes.
new construction condos in Toronto. It's very specific to my market. I'm not suggesting this is happening everywhere, but I certainly see evidence of it in Toronto.
Yes, yeah. Okay, that's probably fair to suggest. Thank you for the clarification there. Where I was going to go with that last point there was just more or less looking at it from a perspective. Okay, well, we both agree that it's probably not going to happen. Like they're not going to just collapse in value, like you just mentioned. Yeah, anything is possible, but as we already discussed, there are all these people out there who are looking to buy. Interestingly enough, what people actually want to buy is being sold at fair market value. What do families typically want? They want a house with 2 bedrooms or 3 bedrooms, or a townhouse or a house or something like that. And you're not seeing those fall off a cliff. And I don't anticipate that to happen anytime soon across anywhere for that matter, unless something crazy happens that could. But barring another COVID or war or something of that nature, I think, which we hope doesn't happen, unlikely. back on track to what we're going on a different tangent right there. So what I did want to kind of circle back on is not being able to ultimately forecast the outcome or change, and assuming things remain the same. You're in a position right now, or if someone's in a position right now where they're trying to decipher, well, to what you just said, well, do I wait for that bottom then? Do I wait for what Dave mentioned? Do I wait for that market to bottom out? Would you tell someone that now is the time for them to hang tight and hold off? And if so, in what markets should they do that or not do that?
Well, I certainly I don't think you can make a general comment about all of Canada. We are very much regional as far as our real estate market goes. But in Toronto, if you were looking to buy a 500 or 600 square foot condo right now, and somebody asked me, I mean, I'm not a real estate agent, but I would be very concerned about prices falling in that segment. To your point, though, Alex, we're not building more detached homes in Toronto. Starts for single family homes are falling, and we've got a massive influx of new immigrants. So if we're building tons of micro condos, they're increasing as a percentage of the overall housing supply. And if you could buy a single family home right now, they are decreasing as a percentage of the overall housing supply. So my personal feeling is very different based on what you're looking to buy. If you're going to buy a micro condo, lots of those coming online, lots of people being stretched because the rates they thought they would get to buy those places are much higher. Lots of questions about what the real value of those properties is. And again, we can allow those deals to close, but eventually people will start unloading those condos. And when they do, they'll be at today's prices, not the prices they paid or the prices that the appraisals supported. So I think there is a price correction coming in micro condos, but it is even within the Toronto market. It depends on what you're buying. Single family homes, generally speaking, when you have a supply demand mismatch and you're not building more to increase supply, prices should typically continue to go up. But it's complicated because affordability is also an issue. Interestingly, Alex, right now, only about half of Canadians have had to renew into higher rates. And you probably know this from your own work. The average mortgage rate right now that people are coming out of is around 3%, and they're coming up into the low fives. In 2025 and 2026, all of the pandemic rates that people were getting at 2% or less are going to have to be renewed. And the payment shock going from those much lower rates to anything close to today's rates is going to be increased. The Bank of Canada has highlighted this as a significant risk going forward. So if you're the BOC wondering if now's the time to cut rates, you've got this, they're calling it the mortgage renewal cliff. You've got this train coming down the tracks where if rates stay where they are now, and we're already seeing slowing in the economy, the payment shock will be, some say, by the Bank of Canada's own estimate, they think it could be almost double what it is already. And if the current payment shock is slowing the economy markedly, then keeping rates where they are, anywhere near where they are into next year and the year after, means the payment shock almost doubles. What does that look like for the economy? So there's even more urgency for the BLC to start cutting rates. And as I said in one of my recent posts, if they're going to skate where the puck is going, then they better hustle to get there, because that's coming. That's preloaded. It's in the pipeline, and that's something they've got to account for.
So it sounds to me like, and I'm obviously just picking up from what you're saying right there, that this, you more or less said it, but feel free to correct me, that you're proposing that the Bank of Canada is obviously seeing what we're talking about right now and everything that we just discussed, and they're going to cut rates sooner than what many are expecting. Obviously, yeah, based on what you said, 2.5% is what you're thinking or theorizing things could hit. Many of the economists are saying 2.75%. I think that's probably the lazy way out. But at this point right now, most projections are putting us at about 2 to 3 years for that to happen. What I'm hearing from you is that you think that this could be more of a 1.5 year timeline, or am I hearing that incorrectly?
No, I think the Bank of Canada has to get moving. I think we will look back and say they over tightened and they waited too long to start cutting. I'd say this: if the average rate cut cycle has taken 15 months over the last 5 cycles, so looking back over the last 5 cycles, takes an average of 15 months for the Bank of Canada to complete its final rate cut. Anyone saying it's going to take 2 or 3 years this time around, I'd love to hear the justification for that. We have record high debt levels right now, government and household. We've got a mortgage renewal cliff coming. There are clear signs of slowing in the economy. All of those things, to me, correlate with more urgency, not less. Now, the Bank of Canada governor has said rate cuts will be, Canadians should expect that they'll be gradual. But of course, he wants to temper the market's enthusiasm and prevent people from getting over their ski tips. So I understand his rhetoric may not match his actions. And by the way, this is the guy who said during the pandemic that Canadians could count on rates staying low for a long time. And we all know how that worked out.
Thank you for that. I love it. Hey, one other thing that I think about when we think about these rate cuts is that we started seeing the predictions of the 2 to 3 year timeline a year ago today. Last summer is when we started to see those projections. I don't know why they haven't really shifted much in that timeline, other than to suggest that the bank didn't actually start lowering rates until literally a couple of months ago in 2024. I feel like that's probably a big part of that. But objectively speaking, I don't disagree with that point of view. Let's go back to one of the other points that you made. So we talked about how people are making decisions now. Before the call we got on, we talked a little bit about what's happening in the banking world, what's happening in the mortgage finance world. For anybody listening and watching this podcast here, you may or may not know that there are different types of lenders out there that get their money from different sources. So we have the big banks, as you know, we have the credit unions, as you know, we have private lenders, we have alternate banks, but we also have these lenders called monolines that you and I were discussing. And you and I were also just deliberating on the fact that these monoline lenders are virtually they can't even play in the sandbox right now. They don't. And what we mean by that more specifically is that a lot of these non-bank lenders don't have the ability to essentially bring their interest rates down to a point that they can be competitive compared to the banks, which is actually, in my opinion, a really, really, really bad thing for consumers in the long run. Short term, good for them because they're getting good rates and great terms, but in the long run, it's going to be negative for the consumer with less choice and less options available. First of all, what are your general thoughts on that? Do you think this is a trend that's going to continue, and how do you think that this will eventually impact the end user, the homeowner?
I agree. There'll be less choice if it continues, but markets are cyclical, and just because this is the lay of the land today doesn't mean it'll be that way forever. Right now, it used to be that you could securitize mortgages for a little bit more than you could use the deposits on your balance sheets if you were a bank to fund them. The spreads were pretty close. And the monolines, of course, the banks have all these checkings and savings accounts that pay lousy interest rates, and that's all cash that they can lend through the fractional reserve banking system. So they have a very cheap source of funds in those checking and savings accounts that they manage for consumers. Monoline lenders don't have deposits, direct deposits, so they have to securitize their mortgages. So if the costs of funding a mortgage using balance sheet deposits and securitization are similar, then the monolines can compete with the banks and basically keep them honest. And because we offer the choice of both, we keep the banks honest as well. But we're in a point in the cycle right now where funding a mortgage with deposits is significantly cheaper than funding through securitization. So what you see is monoline rates are significantly higher than the bank's rates. That is, by the way, not true if mortgages are default insured. The monolines are still very competitive in the default insured space, but you can't spend more than $1 million or more on a house and get default insurance. And with house prices going up so much, that's a smaller and smaller percentage of the market. So the pond for the monolines is shrinking because they can't be competitive in the uninsured market. And banks right now are dominating because they can use deposits to fund their mortgages. And again, I don't want to look too far forward in the future. If this doesn't change, then yeah, eventually the monolines will die and the banks will win, and that'll be bad for consumers because they'll have less choice. And by the way, banks aren't your friend, and you know that because they make billions of dollars every quarter in profits, and that comes straight out of consumers' wallets. Is this the signal that the end is nigh? I don't think so. It's cyclical. Monolines are full of really smart people in management. They will figure out a way to compete with the banks, but right now they're getting short-sighted, and it's showing up in the rates they're offering.
No, I think that's a really interesting point. There's a few big things to key in on that. And for a lot of folks that, listen, they may not know some of the terminology we use. So to break that down, insured is less than 20% down payment, typically is what you're referring to, I assume, when you made that comment. So for an insured mortgage, anybody buying a home with less than 20% down who's purchasing with CMHC or one of the other insurers in the country, these lenders do have the ability to offer you fantastic rates and terms. But as you and I both know, the vast majority of Canadians are no longer getting insured mortgages. Like they're getting 20% down from either a sale and a purchase or a gift or something of that nature. In fact, I would argue that in my current database of clients, which includes a lot of first-time buyers and a lot of people moving and all sorts of different variations, is likely at this point over 80% conventional, which is 20% or more down. So very few people are even playing in that ballpark right now, which is interesting. And I know this alludes back to a conversation of what happened a number of years ago. But for the sake of conversation, I genuinely think that most people, like the average person, why would they, don't understand the negative impact of this towards the future cost of their mortgage. Meaning, less competition equals less value. So your bank's going to fight for your money today, but good luck in 3, 5, 7, or 10 years, especially if there's less competition from the outside looking in. I'm sure you would agree with that statement.
Yeah, one point I would clarify, default insurance can be bought by lenders as well as borrowers. If you put down less than 20%, you have to buy the default insurance. The
Yes.
lenders can buy the default insurance and do something called bulk insurance on the back end. So borrowers who have a property valued at less than $1 million can still benefit from default insurance being attached to their mortgage, even if they're not paying for it directly and the loan to values are under 80%. But the reality is, and that's why if your property is worth less than $1 million, you're probably going to get a better rate at a monoline. But as you say, Alex, most of the deals getting done now are at purchase prices over $1 million, certainly in Toronto and Vancouver. And that's already bad for consumers. And I'll give you one example. If you take a 5-year fixed rate today from a major bank, you're buying for more than $1 million, they will offer you the lowest 5-year fixed rates. But they use posted rates to calculate your penalties. And that increases the size of the penalties that the banks charge on uninsured mortgages. That increases the size of the penalties they charge relative to the monolines by about 4 or 5 times. It's huge. So fast forward to 2-3 years from now. You took a 5-year fixed rate with a bank. You went in and you talked to your branch rep. They dazzled you with a nice low rate. 2 or 3 years from now, I turn out to be right. The Bank of Canada slashes its policy rate. The bond yields, which fixed mortgage rates are priced on, follow in lockstep down. Rates drop to 3%. You're paying 5% right now on a 5-year fixed. You call up your bank and say, hey, rates have dropped by 2%. What would it cost me to break my mortgage? The bank says $50,000. Well, you're stuck. Now you got to hope that rates stay low while you wait out the rest of your term. So not only are you not saving money today, but you got to hope that rates stay low until you get to the end of that term. If you have a mortgage with a monoline at the same rate, because they don't use posted rates to calculate the penalties, that $50,000 penalty could easily be $10,000. And if it was $10,000, the math might well say, certainly if rates fell by 2%, that you're going to save more than it's going to cost to break the mortgage. So you can eat the penalty, but you're going to save it back and then some with the interest rate savings. And you can grab these rates today now and don't have to hope they wait around for you until your renewal date. So there's a lot of flexibility. The monolines want to punch above their weight class. One of the ways they're much better than the banks is in their terms and conditions, particularly their fixed rate mortgage penalties. I've got a borrower beware section of my blog that goes into a lot of detail on this and shows comparisons. And the differences are significant. So yes, when it comes to choice, when the banks have to compete against non-banks, they compete much more fairly on rate and with terms and conditions. If there aren't monolines out there, those penalties are going to get higher, and so are the rates that they're going to offer. The monolines keep the banks honest, and if they're not able to compete, then that's very bad for consumers.
Agreed. And I think the hardest part for a general consumer at this point right now is to stomach paying, substantially in some situations, a much higher payment today to potentially save money in the future. So that's where that long vision or that long sight comes in, which brings us back to that last conversation that we had mentioned, which is if you were to take, let's talk about you. If you were to take a mortgage today, Dave, and you were to consider your options, I think I heard you say that you would be interested in taking a variable rate mortgage, but tell me, is that the case? And if so, why?
I would take a variable rate mortgage today. And again, I'll throw in that caveat again about my opinion in $2 only ever guaranteeing you a hot cup of coffee. But no, I think right now
to turn that to $5 now for the coffee.
Okay, yeah, 5. Well, it depends if you go to Starbucks or not. I'm thinking Tim Hortons. If you are, McDonald's, I think this week headline $1.99 for a cup of coffee. There you go. But I take your point. So if you take a variable rate today, you got to start out with a higher rate. You're going to pay a premium of about 0.75% over today's 3-year fixed rate, and those are really the two terms I would be deciding between: a 3-year fixed and a 5-year variable. I wouldn't want a 5-year fixed. I think at this point in the rate cycle, rates have spiked, fixed rates have spiked. They're still near their highest level in almost 30 years. I wouldn't want to be locking in for an extended period of time. So if I'm conservative, I'm probably leaning towards the 3-year fixed, especially if I'm a first-time buyer getting used to all the costs of home ownership. I like the stability and certainty and the good night's sleep that comes with knowing what my payment will be for the next 3 years. But pound for pound, in terms of which I think is going to save money, again, based on my assessment of where we are in the interest rate cycle and where I think the Bank of Canada is headed with its policy rate, I think variable rates have a good chance to save money, even though you're going to have to start out with a rate that's about 0.75% higher than today's 3 and 5 year fixed rates. Again, you got to be comfortable with that. You got to be comfortable with variable rate risk. And at the end of the day, nobody knows for sure. But I think based on where we are in the interest rate cycle and everything that I think is in store, I think variable rate's going to be the cheapest of the options available.
Oh, well, thank you for sharing it, because I don't disagree with that. I think it's just a hard stomach for a lot of people to look at it and say, well, why would I pay a higher payment today with the projection of a lower payment later?
Yeah.
I mean, obviously, there's the penalty considerations that we've talked about before, with only 3 months of interest to be a factor of that too. Okay, well, that's really, really helpful. Let's finish things off with some deep stuff here. We've got a few more minutes of time left together. And one thing that I've talked about, and thankfully I've had some great guests on the show to unpack this, but I always like to get different context on this, is the impact of the United States and on Canada right now, and what's going on down there south of the border. Now we've seen, and I don't want to date this too much, but we've seen the negative impact on the Canadian dollar recently. Wow. And we're obviously, I mean, I think people that watch my podcast probably know about generally the tie between the US Fed and Canada. I just like to understand it. And again, you can put stats or whatever you want behind this from your perspective, David, as a guy who follows the markets pretty closely, how you think what's happening down there could impact what's happening up here, or change the projection that you shared about, like how closely is that tied in?
Well, we are an elephant, or we are a mouse sleeping next to an elephant, and the government of Canada bond yields move in lockstep with their U.S. equivalents. And for example, if we have a positive economic news that should cause our bond yields to go up, and the U.S. has negative economic news that causes their bond yields to go down, our bond yields are going down. We follow the U.S. and that matters for our fixed mortgage rates. Right now, the Fed isn't cutting. It might cut this week, but so far the BOC's cut twice and the Fed hasn't cut. So that's why the loonie is weakening against the greenback. The U.S. economy is in a very different place. Canada has a reputation for a lot of deficit spending. Our federal government has historically spent a lot more aggressively than the U.S. federal government, but that has flipped in reverse. Right now, the U.S. federal government has a deficit that the U.S. economy has only seen in the deepest of U.S. recessions, and they're still growing. They're still in an economic expansion. So really aggressive deficit spending is boosting the U.S. economy. Also, the Americans have burnt through almost all of their pandemic savings. They've been spending those savings like their plane is going down, and Canadians have been more conservative. So a lot of the outperformance in the U.S. economy we're seeing right now is temporary and, quite frankly, unsustainable. But for as long as it lasts, the U.S. economy, when the numbers are rolling out monthly, is showing more strength than the Canadian economy, and that is hurting us, no doubt. But again, I this is a bit of a contrarian view, but for those reasons and a few others that I go into detail in my posts from time to time, I think the U.S. economy is going to start to look a little bit more like the Canadian economy in terms of a slowdown. I think the Fed is going to start cutting. Might surprise us by cutting this week, but certainly the bond market in the U.S. is pricing in 100% chance of a Fed rate cut in September. But there's no question, Alex, that as the U.S. economy goes, so too does the Canadian economy, and we are 1/10 their size. So we follow where they lead. And right now we're taking it on the chin because of that dynamic, but I think that's probably going to change before the year is out.
Oh, that was perfect. Thank you. You might have had that conversation a few times before. Thank you for that explanation. All right, let's predict forward. We're in the second half now of 2024. We're looking into the fall, and we're asking the question, looking into the crystal ball, do we see the real estate market, and maybe I don't know if you can forget condos, but objectively speaking, do we see the confidence in the market come back in the Canadian real estate market as a whole, from what you can see at this time right now? Or are we still going to see a really, really dull remainder of 2024 with some incredible opportunities, and then 2025 is the year that things take off? So the best of your ability, provide your predictions going forward, my friend, any way that you want to give them.
Well, a part of that will depend on what happens with rates. I think if rates don't fall, I think we're in for a tough market. That said, I think even if rates do fall, the Bank of Canada not too long ago was worried that if they cut too soon, it reignite speculative real estate investment. I think right now the urgency to cut is to save our markets and to prevent them from ending up correcting sharply. So unfortunately, Alex, I think the silver lining on an otherwise cloudy economic day will be that mortgage rates are going to head lower, but I don't think that's going to lead to a robust rebound in our real estate markets. Interestingly, in its monetary policy report last week, the Bank of Canada is now forecasting, they use this term, a robust recovery in real estate investment. I don't share that view. I think people are less likely to dive into major purchases when they're worried about job stability and the overall strength of the economy. There's a lot of doom and gloom in the headlines. And I do think people will buy. I don't think things are going to fall off a cliff, but I don't think, even if rates do go lower, I'd be surprised if we get that robust rebound that the Bank of Canada is counting on in its latest projections.
Yeah, and as you mentioned, those are the projections. I've heard from, I can't remember his name, but the chief economist from BMO suggesting that 2025 or the second half of 2025 is going to be a little bit bonkers out there in the real estate market, and that anybody that wants to snag a quote unquote deal, he didn't say it in these terms, but this is my derivative of his comments more or less, is that this is the year where you're going to find value in the real estate market. And I don't think he's wrong. I don't think he's wrong based on, as you mentioned, uncertainty, people not being willing to move forward. Heck, I just bought a piece of real estate myself because I believe in this market. So we'll see what happens. We'll see if I bet right or wrong, but long term, I'm sure it'll be okay. Dave, I really want to say thank you so much for sharing your time, your energy. Dave's got a fantastic website. We're going to link it up in the show notes so anybody can go and find it. Great blog that he publishes every single week. People in the mortgage industry, real estate industry should definitely have a look at that. If you're in Ontario and hoping to connect with Mr. Dave, please go there and do so. Appreciate you, my friend. Thank you for joining the show today.
Thanks for having me.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.